Welcome to this explainer. Listen, if you've been doom scrolling the financial news lately, honestly, I completely get it. You open up your portfolio, you see a total sea of red, and things look incredibly rough out there right now. You're probably kind of freaking out. But before you hit that panic button, let's take a collective deep breath. Today, we're going to look strictly at the numbers, the history, and the actual reality of surviving a market panic, and we're going to do it together.
So, let's put an exact number on all that panic, 17.6%. At the time the data for this explainer was pulled together, the market was down 17.6% from its all-time high back on February 19th. Just picture a little doodle stickman investor right now, sweating profusely, refreshing his portfolio app over and over, his eyes totally wide with worry. Honestly, that's the collective mood right now, isn't it? It feels like the floor is just totally giving out beneath us.
And the data proves exactly how terrified everyone actually is. CNN Business has this gauge called the Fear and Greed Index. It takes market momentum, price volatility, a bunch of other metrics, and it essentially measures the raw emotion driving the market on a scale of 0 to 100, 0 being absolute sheer terror. Right now, we're sitting at a 4. Yeah, literally just 4 out of 100. That puts general market sentiment deep into the extreme fear range. And really, this brilliantly illustrates why it is so dangerous out there. Because extreme fear validates that intense panic. And that's exactly what leads people to act rationally and sell their investments at a catastrophic loss.
Section 1. Anatomy of a bear. Defining the beast.
Okay, let's dive right into this. We need to transition away from all that raw emotion and strictly define exactly what financial beast we're currently facing. Because putting a name and a clear definition to our fears is, hands down, the very first step to conquering them. Now, you've probably heard the term bear market thrown around in all those screaming headlines, but let's look at the actual mathematical definition. We officially enter a bear market when the market closes the trading day down a full 20% from the previous high. Now remember that 17.6% drop we literally just talked about? That means, technically speaking, we aren't in a bear market just yet, but let's calmly acknowledge reality here. Hitting that 20% threshold at points within regular trading hours means we are dangerously close.
But honestly, why do we even call it a bear in the first place? I absolutely love this visual. Think about how these animals attack in the wild. A bear market is named for the shape the market takes when it drops. It spikes aggressively downward, exactly like a heavy bear swiping its powerful claw right toward the ground. In stark contrast, a bull market, which represents a rising market, slopes upward. Why? Because a bull thrusts its horns up into the air when it strikes. Just imagine our little minimalistic stickman ducking completely out of the way of that downward bear swipe and then preparing to safely grab onto the bull's horns for an upward ride. It's for sure the absolute easiest way to instantly grasp market momentum.
Section 2. The mountain and the yo-yo. A little historical perspective. So the very first historical reality check we find in the data is this. Bear markets are totally normal. It's actually fascinating to see it mapped out. Vanguard recently updated a massive study looking at long-term market results, and their data from 1972 through the end of last year shows something incredibly reassuring. On average, there's been one bear market every 4 years. While the exact timing obviously varies, the crucial takeaway here is that despite the terrifying apocalyptic headlines you're reading, this isn't some unprecedented financial disaster. It's just a regular, fully expected part of the economic cycle.
Let's look at how long these cycles actually last. Based on First Trust data spanning way back from 1942 all the way to 2024, notice the dramatic difference in duration here. On average, a bear market lasts around 11 months, just under a year of pain. But a bull market? That lasts, on average, 51.6 months. That is over 4 full years of prolonged recovery and massive growth. Visually, the briefness of the bear market is just completely dwarfed by the sprawling upward timeline of the bull market.
Now, what's really interesting here is the magnitude of the returns. We just looked at the timeline. Now let's look at the actual money. The First Trust data shows the average cumulative return of a bear market is a loss of about 32%. That's a painful, deep drop into the canyon, no denying it. But consider the bull gain right next to it. The average cumulative return of the following bull market is a staggering 150% gain. The 32% depth of the Bear Canyon is vastly undeniably overshadowed by the 150% height of the Bull Mountain. The ups absolutely outweigh the downs, not just in frequency, but in sheer explosive magnitude.
And this brings us to one of my absolute favorite visual metaphors: walking up a mountain with a yo-yo. When you're doom scrolling, you're obsessing over the yo-yo, right? You see the red tickers, the short-term drops, the yo-yo string rapidly unwinding toward the ground. But what you're completely missing is that the person holding that yo-yo is continuously walking straight up the side of a massive mountain. If you just stay the course, your long-term wealth trajectory is moving steadily upward, even while that little yo-yo bounces frantically around in the short term.
Section 3, the cash out trap. The mistakes of panic.
You have to look at this stunning data from Vanguard. They basically looked at what happens when investors panic during market volatility and shift their portfolios entirely out of the market and into cash, compared to just leaving it alone in a standard 60-40 portfolio. If you flood the cash for just 3 months, you had a 74% probability of underperforming the market. Stayed in cash for 6 months, a 71% chance of losing out. And if you stayed in cash for a full 12 months, trying to wait for the dust to completely settle, you had a massive 87% probability of underperforming the invested portfolio. Attempting to time the market by fleeing to cash almost guarantees you're going to dramatically hurt your long-term wealth.
So why is timing the market so incredibly disastrous? Well, it essentially comes down to a shocking 50% drop in potential gains. The best and worst trading days in the market often happen very, very close together. In fact, about half of the best days happen during down markets. There's this famous statistic from the Great Recession recovery. If you panicked and missed out on just the 10 best trading days during that entire massive recovery period, you missed out on exactly 50% of the potential gains. Literally half of your potential wealth vanished in a puff of smoke simply because you weren't in your seat when the roller coaster started going back up.
Section 4, your financial action plan. Concrete solutions.
All right, so how do we actually build an action plan? First, we absolutely must acknowledge the realities of a bear market on the ground. The stock market doesn't exist in a vacuum, A stock downturn often comes hand in hand with rising prices across the board, increased job volatility, and overall income instability. When it rains, it pours. And this is exactly why having a sturdy emergency plan for your household budget isn't just a nice idea right now, it's absolutely non-negotiable. You cannot panic, for sure, but you must prepare. So the crucial point here is making sure you have adequate cash reserves, and honestly, that strategy looks distinctly different depending on who you are. For older investors, the strategy is all about preserving your hard-earned wealth. We're looking at a requirement of 18+ months of living expenses. This massive cash buffer ensures you are never forced to sell your depressed assets at the absolute worst possible time just to pay for your groceries. But for younger, working-age investors, the goal is job loss insurance. Having a robust emergency fund of 3 to 6 months of living expenses provides the vital security you need to weather a sudden layoff or income drop without having to desperately drain your future retirement accounts. And for those younger investors, I really want you to burn this timeline into your memory. If you remained invested in the S&P 500 for at least 6 years during any period since 2004, you came out ahead every single time. Seriously, let that sink in. That timeline held true through the devastating 2008 financial crisis. It held true through 2018. It even held true through the massive global shock of the COVID pandemic. Every single time. If you maintain a long-term perspective, you realize that temporary market declines aren't actually threats. They're incredible opportunities to buy into your future at a major discount.
Which leaves us with one final, absolutely vital question. You've seen the hard data. The bear is temporary and the bull is historic. You know that cashing out is a massive psychological trap. So, picturing our little doodle stick man standing at a crossroads here, will you let fear rob your future? Trust the historical data, keep your eyes locked on the summit, and whatever you do, just keep walking up that mountain. Thanks so much for joining me on this explainer. Keep learning and keep growing.
Freedom isn't given, it's built, and it starts with what you do next.